So this is part 5 now. We're up to slide 45. So we're going to look at this free cash flow model. So it's December 31st, 2019, which it was 3 months ago when we thought everything was okay. And Dewhurst wishes to determine the value of its common stock by using the free cash flow valuation model. To apply the model, the firm's CFO developed the free cash flow estimates and other data given in Table 7.3. We can now apply the model in 4 steps. Okay, so step 1, first calculate the present value of each cash flow that Dewhurst produces in the year 2020 through 2024. The first several rows of Table 7.4 list those present values. So again, this is in your book, right? So you can just go over it several times. So the present value of the $400,000 cash flow, if you use Excel, you should get that number. If you don't, email me, and again, I will help you. Okay, step 2. Use the constant growth model, right, to calculate the present value as of 2024. So here's the equation for the constant growth model, right? So of all, basically, you get the present value as of 2024 of all the cash flows that arrive in years 2025 and beyond. And because the cash flows grow at a steady 3% clip, right, constant growth over that time horizon, the free cash flow in 2025 is $618,000, 3% more than the 2024 cash flow of $600,000. Therefore, we can calculate the present value in 2024 of all cash flows from 2025 to infinity as follows. So here we have that model for 2025, and we divide by the given weighted average cost of capital that was given in the example and the growth rate, and we get the present value of the stock. And we're using the free cash flows. Finally, since we are valuing Dewhurst in 2019, we need to discount the $10,300,000 figure at an additional 5 years to calculate its present value today, not in 2024. So if you look at Table 7.4, you're going to see that the present value is $6,692,658. So again, this is a good example of using the free cash flow model. Now we add up the present values of the individual flows from 20 to 24, as well as the present value of the flows that arrive in 2025 to get the total value in 2019. So we get the total value. Okay, so now we got the total value. And remember, this is the corporate value. Remember now, this is the corporate. Now, what do we got to do? We've got the corporate value. We've got to subtract off the debt. And we've got to subtract off the preferred stock, right? And we get the value of the stock is $4,726,426. Okay? So here's the value of the entire company when we include the debt and the preferred stock. So the value of Dewhurst common stock is therefore $4,726,426. By dividing this total, right, by the 300,000 shares, we get a value per share, and we end up with $15.75 per share. So that's how one uses. It's a little more complicated, but that's how one uses the free cash flow model. And you should go over that several times in your book. So here it is in a nice little table, right? Here's the free cash flows. And right, so we get the year 2020, and then we break this down for 2021. With this, and here's the weighted average cost of capital. Here's the the growth rate. Here's the value of debt. Here is the preferred stock. And here's the number of shares outstanding. So this is just a nice table that puts everything in one place for that model. All right, so another approach we can use is we can use the book value per share, and instead of using earnings, we can use the book value per share to get the common stock valuation. And basically, what is that? That's the what's the book value per share? Again, that's the amount per share of common stock that would be received if all of the firm's assets were sold for their exact book accounting value, and the proceeds remaining after paying liabilities were divided among the common stockholders. Okay? So here is another example. Let's look at this example with the book value per share. Here is the balance sheet, right? This is a balance sheet, and it shows the total assets of $6 million. You see that right here? Here's the total liabilities, $4.5 million. And here is 100,000 shares, right? Outstanding. So that comes out to $15 per share. And because the book value sometimes is much lower than the market value, because the stock has gone up, of course, this is a pretty conservative estimate, right? Okay, another approach, which we don't have to worry too much about, though, is the liquidation value per share, where you look at how much it's going to cost to liquidate the stock, right? And here is the value per share based on liquidation, right? $6.25 million for liquidation minus the liabilities, and this would be the minimum value of the stock. So there's many approaches to doing this, and there's of course another approach is the PE multiple approach. Okay. So you could look at the PE ratio and look at that approach. And here is the PE ratio of the S&P 500, okay, over different years of the S&P 500 stock index. And here is the PE ratio of many different industries, okay. Industrials, I guess that would be the Dow, basic materials, technology. But they take an average PE ratio for all the 500 stocks in the index. All right, well, I'm going to, you can go over this example yourself in your book, the personal finance example. So I'll just jump over that. If you have any questions, let me know. All right, I'll make another part in a bit.